All right. Thank you for everybody joining us today in investing in 2016 using intermarket analysis. I see we have a nice crew out there. Let everybody coming in. Wow, you guys are really coming in hard. Everybody's on time. That's terrific. All right, so let's just get going real quick. There's no reason to kind of mess around. Just remember that all of this is strictly for educational purposes. Before we get into the agenda, none of this should be construed as investment advice or any sort of solicitation at all. I know you guys know this, but my attorneys like me to reiterate it. Just make sure that, anything we talk about here that you're suitable to do. If you're not sure, talk to your investment advisor or your accountant or your attorneys. And just make sure everything that you want to do that we talk about here, just make sure it's right for you. I know you guys know that, but this is strictly for educational purposes alone. So let's just move on. So we're going to talk about. I'm super excited, guys. We've been working on this for a while. It's been an idea of mine for a long time. This chart book, as my tech guys, decided to name it. But really, what it is it's my universe of charts. It's really my go-to how I approach the marketplace from a global top-down perspective. I'm going to show you guys how cool it is. This literally just launched yesterday, so I'm super stoked about that. So I'll show you guys that in a minute. We'll go over a couple of recent calls I've made over the last month, kind of follow up on that. You guys that have been following me on StockTwits and Twitter or watching me on TV or on the blog or whatever the case may be, know that I've been pretty vocal about my thoughts, what I thought was going to happen. And, a lot of that has really come to fruition, particularly over the last couple weeks. So we'll go over some of that, kind of see where we are in the whole scheme of things, how much further downside we have in equities, and, et cetera, et cetera. We're going to do a little intermarket analysis after that. At the end of the day, that's what this is for, right? Bringing in all of the information that we're getting from asset classes all over the globe to really come up with a thesis and, really find what the best risk reward opportunity is at any given time, but really using a global top-down perspective. And in order to do that, we have to use intermarket analysis. We have to see what's happening in the commodities market. We have to see what's happening in global equities, some of the international names, and how that affects things here in the United States, really what's happening in the currency market and why that's being affected by the U.S. equities market and vice versa, how the U.S. equity market is affecting currencies, and then really what's happening with interest rates, where we're headed, what to do with bonds and everything like that. So that's, when I say intermarket analysis, that's what I mean. All right. And then at the end, I'm going to try to get through this as quick as possible, guys, because I know that I'm going to look at I'm going to talk to you guys about what I'm looking at, but I know you guys have your own thoughts. I know I already got an email about looking at biotechnology. Happy to do that. So if you guys want to kind of save your questions for the end, just so that it doesn't go all the way to the top of the entire question list, give it a few minutes and then maybe write them down, and then at the end we'll get some questions and we'll go over some charts. So I'll try to save as much room as possible for that. I know you guys like that. All right. So before we kind of get going, I'm going to show you guys the chart book, and we're going to look at some charts. So this is at allstarcharts.com/chartbook. It's right on the, you guys can see it right here, allstarcharts.com/chartbook. This was just dropped yesterday for members only. This is really, really cool. You have all of the S&P sectors and subsectors, as you can see here: energy, oil services, everything from airlines to metals and mining, regional banks, financials as a group, home builders, social media, telecom, you name it, it's there. What I think is important. And then also not only at the top 10 sectors, but the subsectors as well. So for example, in financials, you have weekly and daily time frames, but then you also have regional banks and broker dealers. In consumer discretionaries, you have weekly and daily, but then you have retailers and home builders. So then you have the Dow 30 components. I find that extremely valuable. All of the commodities and currency futures, from crude oil to gold to corn and sugar and soybeans, and all of the major currency crosses that a lot of us find important, from Australian dollar to euro to yen, etc. And up here, all of the major global indexes all over the world, everything from China and Hong Kong to Japan and everything in the Pacific, everything in Latin America, Brazil and Chile and Mexico and Peru, all the way down to Europe and all of the major countries in Europe, not just Germany and France, but the Polands, Turkeys, Belgiums of the world and everything like that. And then, obviously the major averages, S&P, Dow, that's a no-brainer, got to have that. And then what I think is the coolest thing is really the intermarket stuff, guys. Everything from U.S. growth stocks to value, and we'll look at those in a minute. But one of you guys is asking me about Intel. I know they just reported. What we can do is kind of just go to the chart book, look at Intel right off the bat. And Intel, I've been very vocal about it, and our members know that this has been a short. We've been talking about it right here. We want to be covering down near $26.30, and you could easily look that up. And this is where we want to be covering our short positions. You want to look at the Intel daily chart, right? That was the weekly time frame. Here's the Intel daily chart. So it's very user-friendly. It's easy for me to update, which selfishly is kind of, the reason this was come up with in the first place. And again, we want to be covering tactically under $30. So we look at things both structurally and tactically. And this is where we want to be covering our shorts in Intel. And this is where we wanted to be shorting it originally when it ran up into that resistance from that failed breakout at the end of 2014. So that one of you guys was asking about Intel, we could do that. Another piece of value I think here is really the intermarket analysis. Here are U.S. Growth stocks versus the value stocks, and growth has really been the outperformer. Speaking of intermarket analysis, this is a great way to see where money is flowing. These are the growth stocks versus the value stocks, and growth has really been outperforming for a long, long time, really since the bottom in 06 and 07. And I think that that's changing. We're at the upper end of this, of these two converging trend lines, uptrend lines. We have a bearish momentum divergence at the recent highs. And I think down we go. I think value going forward is going to be outperforming growth. And I think this chart shows that, and I'll be updating that on a weekly basis. Another good one is small caps versus large caps. This is very important, guys. It's not just about buying a stock and hoping for the best. A lot of times it's a relative situation and taking really the weight of the evidence. I think it's a great example. Small caps versus large caps, really putting in a major, major top. Small caps have been outperforming for a long, long time. And a lot of people just, think that the markets owe them something, and that small caps, are more volatile and they're going to give you a higher return. And, after a long time, we're talking about 14, 15 years of outperformance. Ultimately, that starts to shift, and we've been seeing that over the last several years. And I think down we go. I think going forward, large caps are going to be outperforming small caps for sure. And this chart shows that. And I'll be updating that frequently, guys. Another very important one, we look at the consumer discretionaries versus the consumer staples. I think that this chart really shows that really well. And this is, think about it, if you're a fund manager, right? Here are consumer staples versus, consumer discretionaries versus consumer staples. Consumer discretionaries are essentially where we spend our discretionary income, right? Retailers, automobiles, home builders, some of the more speculative stuff when you compare it to the consumer staples, which are things that we're going to be buying regardless of what the economy is doing. Cigarettes, Coca-Cola, beer, dishwashing detergent, and, all of that stuff, laundry detergent and soap, and those are staples, right? So when you look at a ratio of discretionaries versus staples, it tells you what the long-only mutual fund world as a community is really doing. And they drive a lot of these markets. These are huge market participants. So the way that, think of it as like a cruise ship, right? Because these fund managers have mandates where they have to be fully exposed at all times. Over 90% of the portfolio has to be long. That's what their job is. So the way that they hedge and the way that they outperform the market is that they're going to be allocating money towards consumer staples at a faster rate than consumer discretionaries if they see a market downturn. That's how they hedge themselves. That's how they outperform the market. That's how they get their big bonuses, right? So that doesn't happen overnight because these are huge institutions. So it's more like a ship. Think about it like a cruise ship. You could spot a cruise ship doing a 180 from a mile away because it takes forever. Same thing here. This is a process, right? So in this case, we could very easily see that discretionaries and staples, in this case, we have a failed breakout at the end of last year. I think down we go. Discretionaries have been outperforming staples for a long time. I think that comes down. And I think that that's the market telling us that the mutual fund managers, the big institutions, that cruise ship, if you will, is really shifting and really making that turn. And we could just go over to the next chart real quick and look at a daily time frame of this. Look how simple that was. And here's a very much closer look at that failed breakout at the end of last year, and down we go. Bearish momentum divergence. From failed moves come fast moves in the opposite direction. I think that will be the catalyst for consumer staples to be outperforming discretionaries moving forward. Another one that I wanted to bring up, we talked about Apple is a name that you guys ask me about constantly. I was recently on Bloomberg. We're going to get into that in a minute. I was talking about that. This has been a short, really for almost a year. I still think it goes lower. Bearish momentum divergences. An uptrend in relative strength was broken last summer. This was the 161.8% Fibonacci extension of the entire 2012-2013 decline. We hit that and rolled over from there. The market really cares about these levels, guys. So I know there are people out there that for whatever the reason, they just refuse to do the Fibonacci math, and I don't know why. The market clearly cares about this. And I'll show you guys 1,000 examples. I could be here all night showing you 1,000 examples, or you can just trust me or do the work yourself. The market cares about these Fibonacci extensions, so I think it would be very irresponsible of us not to. So there's a weekly time frame in Apple. Obviously, I've been short for a long time. We've been talking about why. And then on a more tactical time frame, we want to be fading 120. I've been very vocal about fading 120. That's where we wanted to get short again after our initial downside targets were hit in August, and we want to be covering again down near 92. These were the highs from April of 2012, right before we made one more higher high. So that's really, the market has a lot of memory down around 92, and that's where I would be covering. And moving forward, I would just be selling any strength at all. We absolutely do not want to be in Apple. And now a lot of you guys were asking me about, all right, JC, you've been bearish, we've gotten clobbered. Where is support? Where do things shift? And I got to tell you, this week, particularly in the last 2 days, between yesterday and today, a ton of our targets to the downside were hit in a lot of sectors. And I'm going to show you guys right now. I think a great example was regional banks. Regional banks, we had our target was hit, I believe, yesterday. I think the daily chart shows it better, actually. This is a longer term time frame. This is Excel left. Let's look at the regional banks. So here are the regional banks. And we've wanted to be short all the way from up here when we were near 46. That failed breakout was very telling. From failed moves come fast moves in the opposite direction. The risk reward here was skewed very much in favor of the bears. We only wanted to be short if we were below the summer highs. If we were above the summer highs, no reason to be short. We're below it, very aggressively short. And then we wanted to be covering under 39 bucks, which were the closing lows back in August. That was our target. So we no longer want to be short regional banks. Going forward, we want to be fading 42, 43 in regional banks. That's how I look at that. And then I'll tell you, I'll take it one further. Here are regional banks weekly, right? This was all of that support. This is regional banks, all of that support all throughout 2014, early 2015. That was another reason that was our target. So there's no reason at this point, in my opinion, to be short regional banks. This is where we wanted to be covering. So getting back to that, this is financials as a group, which includes regional banks, includes broker dealers. And I'm seeing a bullish momentum divergence on these new lows. We have a new low. This is our target, right? The October 2014 low was our target in financials as a group. We no longer want to be short. I think, honestly, if you want to get cute and you want to buy something, I think you can own financials only if we're above 21.5. If we're below 21.5, which are the October 2014 lows, we no longer want to be in it. Above that, I see no problem. A very clean amount of risk, very well defined, but we want to be fading anything near 24. So this is strictly tactical. I think financials go a lot lower, as I've been very vocal about, except, you want to look at things from a structural standpoint, and then you want to look at things tactically, right? You'll notice in all of my charts that, or in most of them anyway, that I have weekly and daily time frames. These shippers, we don't have enough data to have a weekly time frame, so we only look at the daily. And in some of the intermarket stuff, we only look at the weekly because these are big macro trends. But as you can see, for the most part, we have daily and weekly time frames across the board. I know you guys were asking me about the gold miners. The gold miners are very, very interesting here. I think they're about to break again. Here's why. 1, 2, 3, 4, 5. This is now the 5th test of this support, 13 bucks and change. The more times that a level is tested, the higher the likelihood that it breaks. I think it breaks and we head towards 12.25. And we want to be short on that break. Here's a look at a longer time frame. That 12 and a quarter is our next target that we've been waiting for to hit. Still want to be short, fading anything up here that, especially in November. That's where we want to cover. That was the 161.8% Fibonacci extension of the most recent counter trend rally. So that's really what we want to cover, about 12 and a quarter. That's where we want to be covering our shorts and the gold miners. Moving on to, tell you right now, I want to move on to the airlines, because the airlines have been one of my favorite short for a while, for good reason. They certainly deserved it. Let me just pull that back up. We've loved shorting airlines for a while, and I want to show you guys why. Let me just move this over here. So airlines have been a very clean short, very easy short. We don't need to complicate things for any reason. Here's the airlines index. We have a beautiful uptrend from the lows in 2009, and that broke. It's that simple, guys. It's really that simple. Once we broke, it confirmed the bearish momentum divergence, and then we broke, and we retested that successfully and rolled over. So the short was, as long as we were below that broken uptrend line, we want to be short. It's really that simple. And then looking at it on from a more tactical perspective, it's that simple. We want it to be fading any strength. Here's the broken uptrend line from 2009. We have a downtrend line from last year, from spring last year. Any strength into that, we want it to be fading, and we just rolled over. And we hit our target today, the October 2014 lows. At this point, we no longer want to be short the airlines. Going forward, we want to be fading any strength towards 87, 88. That's how I feel about the airlines. And I'm going to give you guys another couple of sectors that hit our downside target today. We're looking at materials. Materials hit our downside target this week also. This was one that we wanted to be a very aggressively short up here near 46, covering down under 40, which represented the 161.8% Fibonacci extension of the most recent rally that you can't see on this chart. This was the most recent rally back in 2014. We wanted to be fading this level, which had been resistance in 2013, and it rolled over. Now we no longer want to be short. Another one that we no longer want to be short is in the industrials. The industrials hit our downside target today. Show you guys right now. We wanted to be short industrials once we wanted to be fading up here, but we wanted to really start getting short when we broke the uptrend line from the August lows and covering down under 49, which were the September lows. That was it today. We no longer want to be short the industrials. So just getting back, we'll get back to this in a minute. Now just look at the market overall as a group and talk about some of the themes that I've been talking about for a while. And one of them is that the fact that the S&P 500 was running into the 161.8% Fibonacci extension of the entire 2007 to 2009 decline. Okay, coming into last year, that was making me nervous. I've been showing this chart for over a year now, talking about how there's a big level ahead of us. There's a big level ahead of us. I don't know why some people don't do the math on these Fibonacci extensions. The market clearly cares, so I think we should care also. Here's the S&P 500. Also, the NASDAQ composite, another chart that I've been showing, really for over a year, running into those 2000 highs. And the big question and the rebuttal that I was getting was, listen, JC, the NASDAQ is totally different than it was in 99 and 2000. You can't compare it. They're different components. They're different stocks. It's a different economy, blah, blah, blah. Maybe, but the market cares, obviously. The market literally stopped going up when we hit the 2000 high. So sure, is it a different environment? Is it a different NASDAQ? I guess, but the market doesn't care. So I was talking about how the Dow Jones Industrial Average a month ago was really flirting with disaster. I mean, I was very vocal about it. I was on Bloomberg Television talking about it. I was on Business News Network talking about it. I was on Benzinga Radio talking about it. I wrote a blog post about it. I mean, I could not have been more vocal about how, coming into the end of the year, we want to be short. And sure enough, obviously, we had the worst start to a year in American history, is my understanding, or, whatever fun statistic, you want to come up with. But either way, it was extremely profitable. And that worked out great. But the problem now, right? So tactically, it was great. Okay, JC, terrific. You were right, blah, blah, blah. But now what? So the reason that now I think it's actually even worse is because we now have price below a downward sloping 200-day moving average. And that's the definition of a downtrend. So, anybody who thinks that this market is still in an uptrend is obviously very wrong. It's probably been losing money, or is, has their own biases, like on the sell side or whatever the case may be. But this is a downtrend. There's absolutely no doubt about it. We want to be fading any strength back towards 17,000. Any strength at all. I'm not saying we get up there, but any strength up there, we got to be fading that very aggressively. I was on Bloomberg TV in the last couple of weeks of the year, and I made a couple of calls. I said the yield curve was going to break 1.2 to the downside on the 10s minus 2s. I said you got to short the S&P 500 and buy Treasury bonds, and I said you need to short Apple, and I said that you need to short emerging markets. I mean, I was very, very clear. The video's on the blog. You can go see it on the blog. You can go to Bloomberg. You can also see it there. I was on What Did You Miss with Joe Weisenthal. And, sure enough, Apple has gotten absolutely destroyed. We are now below all of these levels. We looked at it earlier. We want to be covering around 92, which are the lows. And ultimately, I think we get towards 85. But from a tactical standpoint, we want to be covering down near 92 and fading any strength towards 104. At this point, tactically, I would not be short if we are above 104. As long as we're below that, we can be short all day. That's how I look at that. And I want it to be long S&P 500, short emerging markets. And sure enough, as bad as this U.S. stock market is, and obviously it's terrible, it's still the best place in the world, except maybe Ireland. But as far as real big economies go, the U.S. is the place to be, and we're still hitting 11-year highs versus emerging markets. That has not changed. One of my favorite emerging markets to short has been Turkey. There's no doubt about it. I've been very vocal about it, not because it's the worst country. There are plenty of terrible ones. Look at anything in Latin America. Oh my God, what a disaster. So Turkey's not the worst emerging market. It's just been the cleanest, right? We only want to be short Turkey if price was below 40. Above 40, we don't want to be short. And sure enough, here we are in the mid-30s. And I think we're heading down towards 27, which is the 161.8% Fibonacci extension of the 2014 rally. I think that's where we're headed. And I would be selling any strength towards 40 in Turkey. I see that Chris is asking me about bonds. If you know anything about me, and I would imagine that you probably do if you're on this webinar. You read the blog, or see me on TV, or follow me on StockTwitch or Twitter, or whatever the case may be. Knows that I've been pounding the table on bonds for a while. We don't want to be in stocks, we want to be in bonds. And then here's a great ratio. I was talking about this on Bloomberg last month, and it doesn't get cleaner than this, guys. This is U.S. Treasury bonds versus the S&P 500, and the TLT represents the longer end of the curve. And we're making a bottom at the same place we made a bottom in 07. It doesn't get cleaner than that. Nice big rounding base. I think this ratio heads a lot higher as U.S. Treasury bonds continue to outperform the S&P 500 as they have for the last couple of years. Here are yields. These are the 10-year yields that I've been suggesting are heading a lot lower. I have a bet with a friend of mine who's the chief market technician at one of the largest financial institutions in the world. And when we go, have beers after work, this is the kind of nerdy stuff we talk about. Where's the 10-year going? And he said 2.5. I said 1.9, and I'm winning the bet so far. So I'm thinking that we're heading a lot lower. In this case, we have a bull flag is what they call it, right? Here's your flagpole. Here's the bull flag. A bull flag is supposed to break out to the upside, right? But it broke down to the downside. So people talk about, technical analysis sometimes, like, oh, that bullish flag didn't work. Technical analysis doesn't work. No, it's not that technical analysis doesn't work. It's just that you're not good at it, right? So what this is, and the reason why this is technical analysis, is because this was a bull flag that was supposed to break out. And there's a bullish resolution is what is normal and more classic. What happens is when a bullish pattern resolves itself in a negative way, the market is speaking, right? There are larger forces at work. It's very similar to seasonality, right? We were supposed to have a Santa Claus rally, but we didn't have a Santa Claus rally, right? So if we would have gotten a Santa Claus rally and the market would have gone up last week of the year, first 2 days of the following year, that would have been great. It would have just been normal. We don't get any data out of that. It's just normal seasonality. The real signal is when Santa Claus doesn't show up, right? what do they say? If Santa should fail to call, the bears will come to Broad and Wall, right? So the real signal is when Santa didn't show up, right? So in this case, the real signal is that the bull flag did not resolve itself in a bullish manner and in fact broke down. So I think we're heading a lot lower. Next stop is 1.9, where we're probably heading a lot lower after that, which means, Chris, we want to be buying bonds, particularly the long end of the curve. So speaking of the yield curve, I've been talking about a yield curve continuing to narrow. This is the U.S. Treasury bonds 10-year yield minus the U.S. Treasury bonds 2-year yield. So traditionally, in a normal economy, the government is going to pay you a higher yield for longer maturity bonds, right? The 30-year is going to pay you a lot more than the 2-year. That's just a traditional yield curve. Goes from the lower left to the upper right. As the yield curve starts to narrow, there comes a point where the short end of the curve starts to pay you more than the long end of the curve. And that's what we call an inverted yield curve. And we're looking at 10s minus 2 up from 2.6 last year, or in 2014 for that matter, excuse me. And here we are at 1 point underneath 1.2. So a yield curve of 2.6 to 1.2. I think if 1.2 breaks, which has been support since 2008, which is breaking as we speak, we're going to get an inverted yield curve, which should send this below zero. I'm not an economist. I don't really care about the economy. I'm here to make money in the market. But my friends that are economists tell me that an inverted yield curve has preceded every single recession since 1960. I'm not here to talk about recessions or economics. I could care less. But as far as what we're seeing in the yield curve, it continues to suggest that we're going to continue to get narrowing and ultimately an inversion, in my opinion. So another reason, this is very just standard intermarket analysis, guys, taking one asset class, getting information from that to make or help with a determination in another asset class. And in this case, we're looking at the regional bank index relative to real estate investment trusts. And then we have the US 10-year yield down at the bottom, right? The benchmark for interest rates. And the reason why this chart is important is because regional banks tend to do well when interest rates are going up and the yield curve is widening, right? Steepening, making it, more traditional rate rises. Regional banks benefit from that environment. Real estate investment trusts, on the other hand, benefit from a narrowing yield curve. They benefit from lower interest rates. And why? Is because investors that are looking for yield, right? Fixed income investors that can't get their yield in the bond market, they have to go into the stock market, into high dividend paying sectors in order for them to get that yield. So that's why when the market thinks that rates are going higher, this ratio should be going up. When the market thinks rates are going lower, this ratio should be going down, right? Great leading indicator for rates. As you can tell, plotted down below, they pretty much behave exactly the same as they should. And regional banks to REITs are a leading indicator, and they're crashing and they're making new lows. 10-year yield has not broken down. I mean, it's broken down, but we're not making new lows below last year's lows from the summer and the fall like we are in the ratio. But I think that's where we're headed. And I think that this ratio as a leading indicator is telling us that. Another big call I made last year, not really a call, but kind of just pointed out the fact that whipsaws are very prominent during that last week of the year. Every single year, guys, go back and read it. Go back and look at the charts. Back in 2011, it was the precious metals with a failed breakdown. At the end of 2013, it was U.S. Treasury bonds with a failed breakdown. Interest rates with a failed breakout. The problem is that last week of the year is very, very illiquid, low volume days. Anybody who's anybody is not at the desk. All of the rookies are manning the desks at the institutions. They got their hands tied behind their back. They're not really allowed to do much. And because of that sort of environment, you get whippy moves that create very fast moves in the opposite direction. And I was suggesting all along that Amazon was the example number one. I thought it was just I was looking out for it, don't get me wrong, because every year they come, and this was the one I found. You can make a similar argument for General Electric too, but I wanted to go over the ones that I was vocal about, and it was Amazon. We made a new high. From failed moves come fast moves in the opposite direction. We wanted to be short as long as we were below 670. This has been a tremendous short. It worked out very well in our favor, and I think it continues to head lower. Here we are looking at a weekly chart, bearish momentum divergence on multiple time frames. I still like Amazon short. Risk management wise, we only want to be short if we are below the uptrend line from the early 2015 lows. Crude oil, I know you guys are going to ask me about it. I've been pretty vocal about the fact that crude oil, we only want to own it if we're above 38. That's the level. 38 were the lows from earlier in the year. That was a big, closing lows back in 2008, 2009. That was former resistance back in 2000 and 2002 and 3 before we ultimately broke out in 04. So that 38 level's been the big one, guys. I say if we're above 38, we can own oil all day. If we're below 38, nothing to do. So here we are. We're below 38. There's nothing to do. And then, getting back to the intermarket, and taking information from other asset classes and bringing them in to the equities market, if you guys aren't doing this, and I'm so happy that now we have the chart book where I have all of the intermarket ratios, all the futures, all of the currencies, so you can really do that intermarket analysis at home for yourself, or kind of just follow along with the stuff that I'm doing. And dollar yen that's the one, guys. You want to think bad things happen to the stock market when dollar yen is below 122. I could not have been more vocal about that over the last year. 122 is the big level. These were the highs at the end of 2014 and in spring of 2015. We had a failed breakout and another failed breakout. 122 was the level. If we were below 122, we wanted to be buying yen and we wanted to get the hell out of the stock market. That was the tell. I could not have been more vocal about it. And there's a very simple reason. When money is scared and money is fleeing risk assets, particularly equities, U.S. and global equities, it's not going to gold, might go into a little treasury bonds, maybe a little gold on a relative basis. Treasury bonds, sure, dollar, perhaps. But you know where it definitely goes to? It goes to yen every single time. So in this case, this is dollar yen. So yen is going up in value as this chart goes down, and vice versa. So as money's been coming out of the U.S. stock market, it's been going into yen, which has been driving this particular currency cross down. And then just to show you guys why that 122 is so important, this takes us back to 2006, 2007. That 122 was resistance in 05 and again in 06. And then here's your failed breakout in 07, and down we go. And we crash with the market because as money was coming out of risk assets, particularly equities, global equities around the world, it was going into yen. So that's where the money was being made. And here we are, an eerily similar failed breakout in the dollar yen, and we're back below 122. Guys, bad things happen if we are below 122, and we are. So I think bad things will continue to happen. A little more intermarket analysis. There's a Russell 2000 versus S&P 500. In other words, small caps versus large caps. And this has been a tremendous leading indicator. And I was saying that if small caps versus large caps at least held those lows from the 2011 and 2014 lows, right around here, I said, we could be all right and maybe dig in. That broke, guys. That broke. That's a big problem. And unless we get a swift recovery, which I think is an extremely low probability outcome, this ratio is going to continue to go lower, and it's going to drag the stock market as a group lower too. Another one that's a problem. These are financials relative to the S&P 500. We need to see leadership out of financials, guys, not financials dragging the market lower. Financials have been a serial underperformer for the past 3 years, really. Very clean downtrend, failed breakout last year. This is a terrible sign for the market. You want financials leading, not lagging, and they're lagging. On the other hand, you want to see utilities lagging, not leading. As utilities were serial underperformers for many years, and now we're putting in a beautiful round bottom, and it looks like we're getting breakouts as we speak in utilities. And this is telling for two reasons. Number one, if the market if market participants were very bullish and thought the market was going to go up, I promise you they would not be piling into utilities. They'd be buying financials and technology and things of that nature. But we're seeing the opposite. We're seeing a safe haven trade into higher yielding, lower beta utilities. And that not only tells us that the market participants are not, trying to be risk averse, but it also speaks volumes about the interest rate market. If the interest rates were going up, money would not need to flow into utilities to get those dividends, right? So the fact that we're seeing utilities breaking out relative to S&Ps goes to show us that fixed income investors think that they're not going to be able to get their yield in the bond market because rates are going to fall, so they have to go into utilities. So, when we talk about intermarket analysis, when you talk about a global perspective, top-down perspective, it becomes a weight of the evidence, right? It's not here. I have this magic tool that if you subscribe to my product, I'm going to tell you when to buy and when to sell, and it's always going to work, and you're going to make money forever. That's a lie. I think all of you guys know that. The way to make money consistently is by constantly trying to build and trying to solve a never-ending and always changing puzzle. Okay, the market is a puzzle, and there's more data to solve that puzzle at all times, and the puzzle is never solved, right? So we try to create themes. We look at the entire world, and we take a weight of the evidence. As you guys are seeing here, the weight of the evidence is suggesting what? Markets are going to continue to go lower. Sure, some downside targets were hit, a lot of them actually. So tactically, we wanted to be covering a lot of our shorts, but we want to be fading strength going forward because structurally, bigger picture, I think we're heading a lot lower, and the market continues to suggest that. Meanwhile, the Japanese yen is telling us to get the hell out of equities and be into yen. Interest rates, everything that's correlated to interest rates market are telling us that interest rates are going lower. You're seeing that in the equities market as we're getting utilities and REITs breaking out relative to regional banks, and interest rates breaking down from traditional bull flags, and the yield curve breaking to new lows, breaking to new 8-year lows. I mean, this is what we're talking about, guys. So it's a weight of the evidence thing for me. So we're going to leave it at that. I hope I kind of got my point across, and I promise you guys that I would leave a ton of time for questions, and that time has now come. So go nuts. You guys can see where to enter the questions. In the meantime, I'm going to tell you what we're doing here. We have a special offer for all of you guys now that we have the chart book at allstarcharts.com. We're super stoked. Quarterly memberships traditionally are $397, while the annual membership is $1297. But what we're going to do is we're going to slash those prices for all of you. And what we're going to do is discount it tremendously, really. Let me just get this. Let's see. What were you going to get? Everybody's going to get a weekly newsletter, basically just kind of summarizing anything that stands out from the previous week, or something that's changed over the last couple of weeks, or a lot of our targets being hit. That's what the weekly newsletter is. Kind of what you just got now, that weight of the evidence sort of thing. That's, touching on all the different asset classes, from metals to energy to all the various sectors to what's happening in interest rate in the currency market. You'll get that in your weekly letters, usually on Mondays or Tuesdays. Every month we have a conference call for members only. Okay, so if you're not a member, you're not going to be able to join our conference calls. Webinars like this are few and far between. If you want to get monthly updates, ask questions, please join us. And then we have a members only forum. This is a community. All of the members of All Star Charts gather together, talk, chat, share things. More importantly, you have direct access to me. I usually answer within 24 hours to specific questions. And here's the most important part. This is a 30-day risk-free trial. Okay, so sign up, set it up, join us, and if after 30 days, if you don't like it, if you don't think it's for you, you get your money back. So it's literally risk-free, doesn't cost you a penny, and I think you're going to want to be with us, and that's why we do this for you, to let you guys try what we have to offer, right? Join us for a monthly call so you can see what it's about. Get 4 weekly letters so you can see what it's about. Look at the chart book being updated on a weekly basis, over 300 charts. And if after all that, after a month, you're still not happy, then, tell me and we'll happily reimburse you. We have absolutely no problem, and I'm happy to do it. So all of you can go to allstarcharts.com/New Year offer. allstarcharts.com/New Year offer. Just go there, and the offer will be available only for a limited time. So please take advantage of it. And again, it's a 30-day risk-free trial. If you're not 197% pleased, by all means, feel free to cancel, and we will send you everything back right away. So I'm going to show you guys the page real quick. allstarcharts.com/New Year offer. So you guys can see what we're working with here. You get a 30-day risk-free trial. Here's the countdown. You know, everything that we get, you know, the monthly conference call, the chart book, the 24/7 member forum, access to myself. And, you know, if you have any questions, you have your FAQ there. You know, I highly advise everybody on this webinar to at least give it a shot for 30 days. What do you have to lose? All right, so let's look at some charts. All right. What specific level? Let's see, Robert wants to know what good information. Your thesis of the markets are heading a lot lower. Yep. What specific level for the S&P 500, and how high will the VIX go? As far as where I think the S&P 500 is going, we got to look at it from two perspectives. We got to look at it from a structural perspective, and we got to look at it tactically, right? So I think bigger picture, longer term, we are headed underneath 1600. This was the former highs from 2007, and it also represents the 38.2% Fibonacci retracement. 38.2% Fibonacci retracement of the entire 2009 to 2015 rally, right here underneath 1600. I think that's where we're going. Now, looking things a little bit more tactically. There's a reason why we wanted to cover a lot of shorts here, right? This level here, around 1890, goes back to former resistance in 2014. We had a little bit of a whipsaw here, but that's been the big support. So for right now, I think that holds. I think we get maybe another rally and we fade anything. And I think that ultimately we break. And that's going to be a problem. I think we're heading towards 1740. So once this breaks, 1740 is the next level. So although we wanted to be covering shorts tactically, I think you need to be fading strength. We have all of this overhead supply, all that. I hope you, Robert, I hope you could see that. All of that overhead supply, those are the people that are left holding the bag that never sold. And now, after we've gotten some extreme selling, that's the please just get me back to break even crowd. I promise to never make a bad trade again. Please, please just get me back to break even. Whenever the price gets anywhere near there, that's overhead supply that's going to be selling to you. So that's what I mean by overhead supply. Those are the bag holders that still own stock that never sold, are just waiting for any opportunity to sell to you. So we want to be selling into them and shorting while they're selling. We want to be shorting with them. Covering tactically down here around 1885, 1890. I think we ultimately break, right? You can draw a nice, very clean downtrend here, Robert. I hope you could see that. Very clean uptrend line, has not broken. Once this breaks, call it 1875, something like that, we're heading lower. So you want to fade any potential strength and then let it break, right? So maybe something like this. Something like that, right? That's kind of how I see it. Does that answer your question, Robert? Please send us this video. Yep, the video will be archived. I will put it up on the blog today, I promise, later on tonight, as long as I didn't screw up the recording, but it looks like we're doing pretty well. Do I offer portfolio analysis? Sure. Members have full access to me, so you can ask me anything you'd like. You know, once you sign up, you have your own private messaging services for premium members only. So just, you know, shoot me some questions. Go for it. Yep. This is for, who asked me that? That was for John. Yeah, John. When will the monthly conference calls be, during market hours or after? They are after market hours, 7 p.m. Eastern time on the East Coast, and they are usually on a Tuesday or a Wednesday within the first 10 days of each month, usually after the first week of each month. And if you can't make it, all of the members-only conference calls will be recorded and will be sent to you. You know, we have members that are in Singapore, for example, or in Europe, and we have members all over the world that, you know, quite, you know, simply just cannot, you know, be available at 7 o'clock Eastern time here in the United States. I know some of you out there that are watching this as we speak tell me the same thing. So yes, I would love, you know, obviously it's in everyone's best interest to be on the monthly conference calls, because you can go ahead and ask questions, you know, and be part of it. But if you can't, you'll get the recording, and then you can always ask me questions directly using the message center. So I hope that answers your question. What's the upside target in TLT? That's a great question. All right, so here's what I'm looking at in TLT. I don't know why I'm not getting any love. There we go. So what I'm seeing in TLT, that's what I'm seeing. I think we buy that breakout. It's wishy-washy, but that's the trend line. We want to own this above that trend line. That's where we want to be. If we're going to be owning TLT on its own, right? Because on a relative basis, I think you can own TLT and short S&Ps against it, and that ratio that we looked at before, I think that skyrockets. So how high do I think that ratio goes? A lot higher than it matters to be in it at this point. And then looking at it a little bit more short term, here's what we're looking at. So here's your downtrend line from the 2015 highs. The problem I see is a flat 200-day moving average. I hate that. So I still think we need maybe a little more backing and filling. I don't necessarily think that this explodes. I think you got a little bit more time, but this is something we want to be buying. How high do I think it goes? I think we probably head towards 132. I think that's where we're going. And then if you're in equities and you're just in TLT, that's where I think it's going. If you're in the futures market and you have the ability to be trading the curve, I would be buying the long end of the curve and shorting the short end. So buying 10 shorting 2s or buying 30 shorting 1. So I like the spread of the yield curve better. But if you just have to be in one security in the equities market, I guess TLT would be the one that's most liquid. Christina, what an incredibly informative presentation. Thank you so much. Thank you, Christina, and anytime. You're always welcome here. What are your thoughts on wheat? Commercials have record long positioning. Yeah, the hedgers have really been getting after it. I've been in the camp that we break down the one more low. Here we can. I've been in the camp that we break down the one more low. 1, 2, 3, 4, 5 tests with a downward sloping 200-day moving average. I think the thing is that we don't have much downside, right? So although I do think we break down the new lows, I think it could be a low that we buy, right? So right around 435, 440, these prior lows here, if we can get a breakdown to new lows, right? Kind of something like down here and then recover, right? So we'll do this. Right? So if we break down the new lows and recover, what that'll allow is maybe momentum. Sorry. Momentum puts in a higher low, right? And we get that bullish momentum divergence. Right? Maybe that higher low and momentum. Sorry, guys. Why isn't it letting me? There you go. Put in that higher low and momentum. Something like that. Maybe a retest and then a mean reversion. Right? Maybe something like that in wheat. That's what I'm thinking, James. I hope that answers your question. So I wouldn't necessarily be prepared to buy it just yet. I would actually want to see one more low and have that create that whipsaw, if you will. I love that. And that's your entry point. So that's what I would be looking at. Is it going to do that? I have no idea. But that would be, in my opinion, the best possible entry point. So, James, I hope that I hope that answers your question. The chart book. Mike wants to know if the chart book is updated weekly. And monthly webinars are archived also for members. The chart book is updated weekly. The sectors are updated weekly. All of the Dow components, all of the U.S. averages and interest rates, all of those are updated every week, sometimes more frequently than that. And the currencies and the commodities, always updated weekly. And then I would say some of the intermarket stuff that are just weekly time frames. These are more structural sort of developments that don't really change from week to week, and those will be updated every couple of weeks. But I will say this, you guys have access to me. So, let's just say, so in this case today, Intel reported their earnings. So I updated the chart just because I was looking at it anyway, because I wanted to see where it was. So I went ahead and updated the chart. So while some of the other Dow components haven't been updated in 3-4 days, Intel was freshly updated because they reported earnings today and they're getting crushed, and I thought it was a good short, and I wanted to talk about it today. So whatever the case may be, if you're on the chart book and you see something happening in coal or in South Africa or Thailand or in the Russell 2000 or in something that hasn't been updated for a few days, and you think that there's a major change happening, and or even if you don't and you just want to confirm, you have direct access to me. So, hey, JC, you haven't updated your Australia charts in a couple of days. Would you mind going ahead and updating it? And I'm happy to do it. And I win on that too, by the way, guys. So don't be afraid to do that to me, because you guys are going to catch things that I'm not. I mean, it's impossible for me to see everything. So if you guys are seeing something change in a particular chart that I haven't, perhaps updated in a few days, you guys are helping me too. So I'm all for it. So although I might not update something for a week, I'm happy to do it on the spot. Do you use Elliott Wave, JC? I do a lot of Fibonacci stuff that can be construed as Elliott Wave, but I'm not the guy that's going to be counting, 1, 2, 3, 4, 5, ABC, 1, C. I'm not that guy. I have a lot of friends that do, and I'll get on the phone with them or on Google Hangout, and they'll show me their 297 counts, and I'll disagree with them or agree, and I'll give them. I mean, I know Elliott Wave. I was forced to study it during the CMT program, so I know it all. So I can do it. I just don't on a regular basis. It's just not for me. Twitter opinion, if we must. This is a train wreck. I mean, there's no doubt about it. You want to be fading this form of resistance. I even said back then that if we were able to break above 32 and kind of hang on there, it's got a shot, and instead we rolled right over. So there's no reason to be involved. Anybody that owns this has been losing money, has been wrong, and they deserve it, quite frankly, because there's been no reason to be in this. It's zero. This is a downtrend, no doubt about it. Now, I know that it's a sexy name, and we use Twitter, and people like to talk about it, blah, blah, blah. That's terrific. I think you still got to be fading strength. I mean, today, beautiful candle. Look at that candle today. Isn't that nice? Momentum hit oversold again. If we get follow through tomorrow, I think that would be good, because it would make the weekly candlestick stand out and maybe get some upside follow through towards 23. So if you're a very nimble tactical trader, that's 4 points from 19. That's a monster move. So in that case, sure. I just think there's better places to be. I got to tell you, I look out. I use an intermediate term time horizon. So in other words, I'm looking out weeks and months. I'm not looking out hours and days. So this is a little bit short term for me to be bottom fishing an absolute train wreck in a bear market in U.S. stocks. So I think if you're forcing it. If it goes to 30 without me and I'm not in it, I'm not going to cry about it. I don't care. Because it's not a trade that I would put on. So I'm just being honest, John. I'm sorry if that's a little wishy-washy, but that's how I feel. That's the truth. How long do I think crude oil drops? I don't know. I said that we would only own it if it's above 38, and it's been below 38. So where can it go? I hope it goes to zero. I have no idea. Members will get updates, right? So as we get more information and we have a good risk reward opportunity, whether it's on the long side or the short side, our members are going to be the first ones to know. Where we sit right here today, right now, I say it's a no touch. There's no reason to be in it. That's how I see it. How do you decide when to apply Fibonacci, and when you do, when do you use an extension retracement? How to decide where to start and where to stop lines? Well, Trent, if you go into the chart book, you're going to be able to see every single chart. There's over 300 of them, and all of them have their Fibonacci retracements and extensions drawn up, in some cases both. Well, we want to use extensions when we're in an uptrend making new highs. We want to use extensions in order to find where the next price target is. Or if we're in a downtrend and we're breaking to new lows, we're making new lows, we want to know where the next target is, that extension. How do I get the extension? Where do I start my Fibonacci? In a downtrend, I take the most recent counter trend rally. In an uptrend, I take the most recent corrective sell-off and take that to the prior highs, and that'll give me my Fibonacci extension. When it comes to retracements, is if we make a high and prices start to fall, I'll take the last major low and the last major top, and I'll take the Fibonacci retracements based on that. Or if we're rallying within a downtrend, I'll take the most recent major top and bottom and take the retracements from there. So I choose extensions versus retracements depending on what I'm looking at. Is it making new highs in a trend, or is it retracing a previous trend? I hope that answers your question, Trent. And if you want, by the way, I'm pretty sure I wrote a blog post about that a couple of years ago. If you want, email me if you can't find the link. But if email me, I'll find it and I'll email it to you. Trent, I'm happy to do it. Biotechs. Promise you guys we'd look at biotechs. I mean, this has been one of my favorite shorts for sure. Absolutely. You know what? We can actually look at the chart book for this guy. We'll look at the at biotechnology here in the chart book. Here we're looking at the weekly time frame in biotechs. And we hit our, speaking of retracements, we hit the 261.8% Fibonacci retracement of the 2014 correction, and that's where things peaked. And now we broke the downtrend line, so the uptrend line from the 2011 lows, confirmed the bearish momentum divergence. I've been talking about being short biotechs for months and months, since late in the summer, actually. You guys who read my stuff know that. And now we broke this uptrend line. So I think going forward, you got to fade any strength back into that broken uptrend line. And then we'll look at a daily time frame real quick so you can see a little bit more tactical approach. Our downside target is just over 50 bucks, which is and Trent, to answer your question, notice how this is a downtrend, right? We made a new low. So in order to get what the next target is, you take the most recent corrective rally, which is the rally we got from September to November. You take that, and the 161 extension of that move takes you just above 50 bucks, right? So that's our target. So we want it to be shorting, fading any strength into this level, and covering down there. And now that momentum's oversold, I still like that, and I think we fade any strength towards 59, and you cover down there. And that's how I see it. Going forward, we do not want to be short if we're above the lows from August and September. So although we want it to be short, at this point, it's more of managing the position, right? So we no longer want to be short if we're back above the former lows from August and September. So in other words, readjusting our risk management procedures. So I hope that answered your questions, Harry. JC, excellent presentation. Thank you. I appreciate it. Richard. All right. Well, listen, we're going to call it. We're going to call it there. If you guys have any direct questions, just sign up and, feel free to email me and we'll go over everything. Make sure that you're using the premium only message center. Again, just to reiterate, this offer is going to be done at the end of this weekend. Guys, take advantage of it. These are huge discounts. I think that the package, this is work that I'm doing anyway, so I'm happy to share it with you guys, but I think this is worth a lot more than what we're charging. You're getting 297 bucks for a quarter. If you're not happy after 30 days, you get your money back. So it's literally risk-free. So to not try it out for a month, get the charts, see how the charts develop. You're getting a weekly newsletter that, I've gotten a lot of great feedback from that. I just kind of, tell it like it is. You guys that have been reading my stuff for a while know my kind of writing sort of approach. Yes, Adi, you will get a recording of this. It'll be on the blog tonight, I promise. And guys, it's a 30-day risk-free trial. You have 300 charts. You get a weekly letter. You have a conference call every single month. You have a community forum that is just for you guys, and you have direct access to me. So, if you're serious about the market and you want to make money, you're not interested in gossiping or, the noise or any of that nonsense that you see on TV. Remember that the media has a specific goal and business model, and it's to sell commercials and it's to drive traffic. It's not to help you make money in the market. We are here as market participants, as a community. We're in this together. We are trying to navigate through this market together, not just day trading Twitter, but we're looking at global equities all over the world, in Japan and China and South Africa and Latin America. We're looking at interest rates all over the world. We're looking at the Brazilian Bovespa. We're looking at ratios between small caps and large caps, growth versus value, stocks versus bonds, EM versus S&Ps. All of this helps us to get the weight of the evidence and come up with a thesis and come up with a theme. And I think that I do a good job of that. I work harder than anybody else I know. I know we've had members and people that have been following me for many, many years. I've been around for a while. I'm not going anywhere. So if you want to join our community and you want to do this together and approach the global marketplace, purely from a strict risk management standpoint and look for good risk reward opportunities every single day, join us. Thanks, guys.